Anyway, so let's move on. So we always invite a guest on to talk about the most important event of the week. And this week we're joined by Aidan Garrib. How's it going, Aidan?
Pretty well, guys. Although I'm not drinking a summery beer right now, but I will be very soon.
Oh, nice. Well, Aidan, you prepared a fun chart deck to talk to us about China. So I'm looking forward to jumping right into this. So, what's on your mind on China here, and what are we looking at here? Let me just launch this into.
Well, I think there's a number of themes right now that are driving markets at the moment, and from my perspective, China seems to be the most misunderstood. So I really want to explain my thoughts on what's going on in China and then discuss the implications that this has for markets going forward. So here on page 2, what you can see is Chinese producer prices and U.S. core PCE, so the Fed's preferred measure of inflation. And so Chinese PPI tends to lead U.S. core inflation by about 12 months. And this shouldn't be a surprise to anyone who's ever walked into a Walmart and picked up anything and it says made in China on it, right? So as this disinflationary pressure has mounted over the last year, the Fed's become dovish. And we think they did so not just because of the impact on U.S. inflation, but also because China's options are becoming increasingly limited. And a wrong policy move on behalf of the Chinese, or on behalf of the Fed for that matter, could actually destabilize the global economy, which is something I'll try to clarify in the coming slides. But I've just been struck that this hasn't really been something that many people have spoken about. And so that's the reason I really want to get into it with you guys today. So on page 3, and by the way, feel free to jump in at any point, ask questions, call me an idiot, yell at me and tell me I'm wrong.
No. We don't do that to guests. We just do that to each other, Aidan. Like, we have a strict rule. You're not allowed to call the guest an idiot, but Patrick and I are allowed to call each other idiots, and you're allowed to call us an idiot.
Okay, right. Sounds good. Yeah. I like the asymmetry in that trade.
So what we have, by the way, so what we're showing here is the Chinese. Do you, on this chart though, before we move on to chart 3, do you believe that this is a turn point in Chinese PPI, or do you still think that this is heading lower?
I think we've seen a bounce, but by and large, I think it's heading lower, and that's really what I'm going to get into, which is this misconception where I think the market is looking for, this stabilization or recovery in China. And they may stabilize, but it's going to be at a much, much lower level than I think the market is prepared for based on market action.
So this chart going lower implies that you think that there will be less inflation or disinflationary pressures in the U.S. Is that fair to say?
Yeah, that's exactly it.
So,
I love this guy, Kevin. I love this guy.
Patrick is all over that. He's going to love this. Okay, so let's go to the next chart. Let's see why.
All right, so on page, I guess we're on slide, so on slide 2 now, you can see the eminence, I guess, of this disinflationary pressure. And it really started with this buildup that we've seen, overcapacity buildup in China over the last, 20 years. And we've seen this brief kind of bounce, but overall, you look at the industrials and you look at the metals complex, and that seems to be rolling over again. So I think China is really in this tough spot here. Now, why do I think that this is going to fade? So go on to the next slide, and I think this is really where you start to see the problems emanate, which is the credit space in China. So this chart, I guess it's a little bit complex. You have the reserve requirement ratios for the banks. So that's just the amount of money that the banks have to set aside and what they can lend. And so you've had this massive slowdown in Chinese growth, but they haven't really pushed major stimulative policy. In fact, I would characterize the Chinese policy response as somewhat underwhelming. They've cut these triple Rs, but you're seeing here that it hasn't spurred much credit growth. And in my view, this is because China faces this impossible trinity, which is brought up often, but I think it's quite important in this context. So what does that mean? Well, economic theory would tell you that you can't have a stable exchange rate an open capital account, and independent monetary policy all at the same time. So if they cut interest rates, there'd be some capital outflows and the currency would weaken. So let's kind of unpack this in turn. So the RMB, the renminbi, it's a pegged currency, right? It trades within a narrow range. And the easiest way for China to boost growth again would be just to flat out come out and devalue the currency. But they can't, nor do I think they really want to, which is something I'll cover. But, with this trade war going on, you have Trump that's coming out and saying, warning them not to devalue. You have Mnuchin coming out and saying, we're watching the currency, don't devalue. So China can't devalue. So the currency's pegged. Well, what about the capital account? Well, ostensibly, China has a closed capital account, but really, they just crack down on capital outflows. North Korea really has a closed capital account. And if you doubt the openness of China's capital account, then I invite you to come to Canada. Well, you guys are in Toronto already. So, go to Vancouver, go to Toronto, and look at the real estate prices there, right? Look at the fake import invoices. So China does have a pegged currency, and de facto has an open capital account. So that must mean that they import U.S. monetary policy. And that's too tight for China. That's why they're resorting to these RRR cuts, and that's why it's ineffective. So let's drill down to this in a little bit more detail, because I think here's where it gets more interesting. So Patrick, please go to the next slide.
Right.
So this is China's credit puzzle. So the problem for China is they developed under a dollarized financial system, right? In an ideal world, or if you look back historically, China exports stuff and get dollars. Those dollars get converted to RMB. Some of that sits as reserves in the bank sector, and some of that gets lent out. We'll take a look at what's happening here. The PBOC, or the Chinese Central Bank's balance sheet, their assets are declining, and more importantly, foreign assets, i.e. dollars, are declining. So that means that by the transitive properties of accounting, that means that central bank liabilities must be declining too. That is what we see. And in fact, look at the portion of liabilities that are contracting the fastest. It is these commercial bank deposits with the PBOC. This is the definition of money. So money in China is contracting at 12% year on year. This is the epitome of disinflation. This is really the problem in China. As they bleed dollars, they have less dollars to back the currency. So the actual credit growth that they can generate becomes increasingly limited. Now, you guys might say, well, hold on a minute, Aidan, you're an idiot here. I've looked at, the news over the last few months, and I've heard there was a resurgence in Chinese credit growth.
I was about to ask you that, Aidan, because no, it's not. I wasn't going to call you an idiot part, but it was the part where there's this big surge in the credit and the social financing in China. Is that the response mechanism to the fact that they're experiencing this? Is that linked to the fact that they're trying to stem this bleeding and kind of rebound this, or am I not connecting the dots properly?
Yeah, so they're trying. And so what they're doing right now is they've actually imposed some tougher capital controls on commercial banks' deposits offshore. So because China has this Belt and Road Initiative, there's RMB sitting offshore in, for example, Bank of China's accounts in Mongolia or whatever. And they've effectively just stopped that from being lent out. And they're using that, it appears, to try to spur credit, along with some of the inflows into Chinese equity markets and some other ways that we'll get into. But if we dig into the next slide, I'll show you the credit growth story, both the formal and so on this slide here, it's formal credit growth, so, typical banking sector credit, the shadow credit, and then something called SOE, or state-owned enterprise fixed asset investment. So let's look at these all in turn. So at the beginning of this year, there are these calls of, formal bank sector credit is growing quickly again. China's coming back. Well, actually, when you look at the formal banking sector credit, it just reflects more of kind of the cyclical trend that you tend to see in China, which will become apparent later on. But it doesn't really seem like there's that much of an extra boost here. Where we are, the lines that I would focus on are the ones at the bottom, the light blue and the red, which is the shadow banking credit and the state-owned investment. So the fixed asset investment, the roads, the bridges, the highways to nowhere, all that stuff that we've come to know and love from China. So what you can see on this chart is post-GFC, China saved the world, right? There was a massive expansion in credit from the formal banking sector, which spurred growth. Since then, it's been shadow credit. So we saw in 2013, 2014, and again in 2016, this shadow credit that drove growth, and in doing so helped reinvigorate and reinflate the global economy. Now, the formal credit we've heard so much about since the beginning of the year, it's basically just used to roll over existing loans. And I think you see this on the next slide quite clearly. So this slide shows you two things. It's the ratio of short-term to medium and long-term bank loans in China. So one to households and the other to non-financial corporates. And so increasingly what you see here is that the short-term loans become an increasing proportion of total loans. And this seems to increase every year because the banks are apprehensive to lend within this slowdown. So at the end of every year, loans come due, both short-term and long-term loans, and then they tend to refinance most of that with new short-term loans. So that's why you're seeing this kind of cyclical pickup in Chinese formal banking credit. It's nothing more than just short-term loans coming up for renewal because banks don't really want to extend credit. So why does all of this mean that China can't stimulate enough now, and why does it matter for global growth? Because I think that's kind of the key question here. So if you go to the next slide, I'll show you once again, this is the fixed asset investment in China, which again drove growth post-GFC, again in 2013 when global growth was slowing, and then again in 2015, 2016 when global growth slowed. So can China do it again? One more turn. Go to the next slide in this deck. Look at why I think they can't really do it. So this is M1 growth in China. If following the financial crisis in 2010, money supply, so M1, grew at 40% year on year. In 2013, it grew at another 15%, and in 2016, it grew by another 25%. So can China do that now? Well, M1 in China is 256% of GDP, and investment is less accretive to growth than it was in the past. So sure, they could try to boost the money supply by another 40%, but I don't really think they could do so. The reason is on the next chart, you see kind of the hamstrings to Chinese money supply, which is, again, China has been a dollarized financial system. Well, China's not seeing inflows from the current account, and the central government is running a budget deficit, to say nothing of the local government. So China's already kind of burning through all this cash. It's one thing to spur more credit growth if you were getting U.S. dollars in, but they're not anymore. They're actually burning through this, and you can see the reserves. That red line at the bottom it has turned negative. So I guess they could turn on the printing press, but that would cause massive devaluation in the RMB. And it would effectively risk $1.6 trillion of debt defaults in EM Asia, which I'll get to in a minute. So you might say, well, okay, but the Chinese data is saying something, and you're saying something else. So, can you corroborate your view, or do I just believe the Chinese data? Well, let's see where we can corroborate the Chinese data. If you go to the next slide. So these are the countries that typically export to China, right? You have Taiwan, Australia, Korea, Japan, Brazil, ships to Myanmar. Nor. Well, look at what you're seeing here. By and large, you're seeing exports contract at, between 2.5% and 20% year on year, with the exception of Australia. Well, let's look at export trade by volumes. So if you go to the next page, look at export volumes, right? Broken down by EM region. They're all sharply following. In fact, that second derivative, that line's, looking like a steeper and steeper fall. Now, right. Let's look at one other place to corroborate it on the next page. So this is, Germany. So Germany is an industrial powerhouse. They export a lot to China. Look at what we saw there. This is an interesting chart because it's German industrial and manufacturing orders in volume terms. And the German data, like everything else out of Germany, is pretty good. you get it monthly. So look what we saw. Chinese PMIs picked up in early 2019. We did see an increase in this German industrial activity then, but since then it's started to fade. It's really started to roll off. So it just looks like a sharp bounce, and it doesn't look like it's going to be sustained. And so here's where things actually get much more interesting for China, is on the next page. So this is Chinese export volumes, right? And global trade volumes. So look at what Chinese exports are doing right now. They're contracting at 4.1% year on year, far sharper than the slowdown that we're seeing in global trade. Well, the last time that Chinese exports were contracting by this much was in 2015. What happened in 2015? We woke up one day to find out that Chinese policymakers had decided to devalue the currency, right? Well, one part of me says they would like to do so again. The problem is that, as I had alluded to earlier on, is there's about $1.6 trillion of dollar-denominated non-financial corporate debt in EM Asia, right? So again, to say that again, non-financial corporate debt denominated in dollars in EM Asia is $1.6 trillion. About 50% of that sits in China. So if China devalues the currency, they risk spurring 800 billion of defaults among their corporates. Worse is the fact that the rest of EM Asia, which actually exports to or competes with China for export market share, they're forced to then devalue, and then that risks spurring the other 800 billion worth of defaults there. So I think China is sort of hamstrung here in the fact that they can't really devalue, and the Fed, I think, sees this, and that's why they've become somewhat easier. Now, one thing that's even more interesting than this is I don't actually think China wants to devalue. And if you go to the next page, I think this is maybe a chart that shows you why I don't think they want to devalue. So here's some of what I call the practical limits to China's devaluation. So these are commodity prices priced in CNY, right? Chinese currency. And these are the commodities that matter most to China. So in 2015, when China devalued the currency, they were able to reinvigorate exports, right? Well, it was kind of a Goldilocks situation for China back then, because look at that dark blue line, which is oil. So although China devalued the currency, oil denominated in RMB was actually falling much faster. So it was a great Goldilocks situation for China because they devalued, their exports became more competitive, but oil fell faster in RMB, and so it didn't lead to any kind of PPI increase or it didn't cause any strains. Now what we're seeing is the commodities that China relies on the most for industrial growth, they're actually increasing in CNY terms. So if China devalues, it hurts them even worse. Yeah.
All right, so Aidan, now what if, like, as we just saw a pretty notable 1-2 day drop in copper prices, even oil seems to be, at least in the last few days, coming off its peak highs. By no means am I trying to already suggest they're in a downtrend. It takes more than a few days to put something in motion. But would your narrative change if commodity prices demonstrate in the coming month that they've reached some sort of intermediate highs and that they may actually start to weaken? Because if that scenario, and I'm not trying to make that as a prediction, but what if that was something that was to develop? Could that change your view that China may be more inclined to move their peg?
To devalue. I think it would be tougher for them, right? The reason I say that is, and this is a good question, the reason I think it would be very tough for China to devalue the currency is because of that green line there, right? Which is gold priced in CNY, which has been stable compared to all the other currencies. Now,
right.
If you are Saudi Arabia or you are Brazil, so China's not just trying to denominate more of its commodity purchases in its own currency, right? Because once it does, it wins, right? Just like the U.S. has been able to denominate trade in its currency, and it's, there's a benefit that's accrued to it as the global reserve currency as a result of that. Well, if you're Brazil or you're Saudi Arabia, you don't need to hold RMB, right? Global trade's denominated in dollars, and to the extent that you have foreign currency debt, that's probably denominated in dollars too. So, sure, China may arm twist you into selling oil to them under their RMB futures, denominated futures. But once you sell them the oil or whatever the commodity is and get RMB, your best interests are effectively, dump the RMB for dollars. So why would you hold RMB? Well, you'll hold it if it's as good as gold, which so far it has been. Now, the problem then is for China, if they devalue the currency and gold starts to fall in their own currency terms, then, what's the incentive for these countries to really hold RMB? And it sets back, in my view, China's aspiration of being able to denominate more of the commodities that they need in their own currency.
Right. And now I've heard though from really smart people like Russell Napier who make the argument that because of the situation with China's current account, that they themselves it's untenable for them to actually maintain the currency at these levels. And at least Russell Napier speculated they might actually just float the renminbi as because it's not tenable for them to drop it because it's just it would be too much political pressure from U.S. Under those circumstances. What do you think of a story like that? Is that just in your mind nonsense, or is there something behind that?
No, I think there's something to that, and I think that is what will eventually happen. But I think before that happens, what China needs to do is take more concrete steps to clean up its banking sector, clean up the debt. Because if you just devalue the currency, then again, the risk of default just becomes too great, and that sets your economy back even further. So I definitely agree with Russell Napier and others who say, look, the path of least resistance on the currency is downwards. And in fact, that's why China has capital controls, right? It's to stem the downward pressure on the currency. I just don't think that they can do so until they finish, getting their credit house in order, so to speak, and cleaning up the NPLs and the debt and recapitalizing the banks. And that's what they've actually been trying to do. And so my view on this is that, look, it looks like we're going to so the BOJ still is doing QE. It looks like they're going to continue to do that forever. The ECB looks like they're going to have to go back to QE as well. And the Fed has gone from, talking about the balance sheet reduction being on autopilot and hiking to now saying that, the balance sheet is going to stay stable. And I think they're actually going to have to expand the size of the balance sheet sooner rather than later. And then I think China can come in and take some steps to do some QE. And look, China already has put in place like a bad bank to effectively take some of these bad loans out of the formal banking sector and recapitalize them. And so once they do that, I think they can devalue, but I don't think they can devalue. I don't think they can devalue in the interim before they do that.
So now there's we're approaching halfway mark of 2019. Do you think that that something in China plays out in this calendar year, or do you think this is more of a 2020 story?
Well, I think the thing to watch first is watch the Fed, right? Because we're seeing this, tightness of dollar liquidity that's really been impacting China and other EMs. And I think as you see the Fed become more dovish, which is kind of my base case, is they go back to expanding the size of the balance sheet, then you can get China make these moves. But I don't think it will happen before the Fed. So my view is the Fed does it sooner rather than later, and then the Chinese will follow suit shortly thereafter.
Right. So it's Kevin here. I'm just going to jump in. So, Aidan, so you think that the Chinese are hamstrung in terms of devaluing because of their own internal issues and not because of external political issues that, put on them by Trump?
Again, there's both. So I'd mentioned that, they can't devalue. So they can't devalue because of some of the debt reasons, but then they also can't devalue because then that makes the trade war more acute, right? Because Trump has said not to devalue. Mnuchin said we're watching the currency. So I don't think they can devalue without making the trade war more acute. So there's both internal and external reasons that hamstring them from doing so.
So you've just one second. I'm going to keep going, Patrick. So you've kind of
Yeah.
posed quite the big kind of pile up in front of the goalie here in terms of all the problems that China is facing. Do you think that they're going to be able to stick handle through and put the puck in the net? Like, are they going to figure out a way around this, or do you foresee this kind of erring much more on the side that eventually China is going to run into some troubles, and that the next crisis is coming out of China?
So I mean, all the capitalist countries have run into recessions. They've been trying to figure out their way around this. So can China do it without, can China find success where the others have failed? Maybe. My view is that they're rushing to put in place these policies to make sure that a crisis doesn't occur, right? So they've started the bad bank that's trying to take these bad loans, and they're trying to clean up the financial sector so they can eventually devalue. The question is, like, where does the blow up come from first? I actually think it probably comes from outside of China. In my view, it'll probably come from from some of the high yield sectors in the U.S., the CLO market. You're likely to see some risks there. China, I think you're
How about
seeing
the emerging markets? Do you think some other of the emerging market players could be problematic in that, or even Europe? Like, you think it's just high yield in the U.S. that could do it? Like, where's your kind of problematic areas around the world that you think some of this crisis could develop?
Yeah, well, you're seeing it in EMs right now, right? In Turkey and in Argentina. And it's actually funny because, look, when we had the strong dollar last June, it's the same thing, right? You saw the blowups in the weakest emerging markets first. So I think that's more or less what you're seeing play out right now. If there was to be something acute outside of the kind of CLO market in the U.S., I think it would come from emerging markets who finance themselves in dollars, because dollar liquidity is getting tighter, and if the Fed doesn't kind of turn dovish sooner rather than later, these EMs are really going to start coming under strain. So it's not just Turkey or China, but you're also starting to see some pressure in places like South Africa as well. Korean exports are falling. So it's the broader EM complex, I think, is vulnerable to this.
So Aidan, it's Kevin here again. So Aidan, you've given us quite a lot to think about in terms of this. This chart pack is just outstanding, and I feel like I should stop drinking beer and focus on the charts.
Drink more beer.
I was like sitting there. I was like, oh my goodness, this is actually, I got to think. What's he doing to me? I just kind of, I've been probably on the other side of your trade in terms of, I've always contended that China is not going to be as bad as everyone thinks. But you've definitely piqued my interest, and I'm, great trader always stays open-minded. And at the beginning,
I personally think his ideas
of course
are brilliant.
You do, Patrick.
And
listen,
right
I just want to finish up with one
Yeah.
last thing. So you mentioned that you thought that the market wasn't appreciating your view, and you went through and you articulated very eloquently why this was the case. If this is the case, and the market isn't appreciating this view, what do you think the best kind of portfolio moves are, or at the very least, what do you think people should look at in terms of? Because I believe that what's that old Mark Twain, or actually it might not even be Mark Twain. That old expression is not what you know that gets you in trouble. It's not what you think you know that gets you in trouble, or something to the effect that it's what you know for sure that just ain't so. What do you think the market thinks it knows for sure that just ain't so, and how do you take advantage of that in China?
Well, if you look at, for example, look at the copper to gold ratio, and then look at MSCI EM, or look at Chinese equities, there's been this huge disconnect where the market's expecting profitability to come back to Chinese firms, right? And that hasn't been the case. Where we have seen profits over the last few months has largely been in the upstream state-owned enterprise sector. And that really just has to do with the fact that there was a rush of demand for firms lower, or I guess more downstream, to buy goods from them ahead of the VAT reduction, because they could claim that back on they could get a tax deduction for that. But so, I see this disconnect when I look at the massive run-up you've had in these Chinese equities since the beginning of the year, but to the traditional metrics that you'd like to see accompany a rally in Chinese equities or EM equities, like commodity prices, just hasn't been there, right?
Right.
Something else I would look at is FX reserve growth among EMs. It's contracting, right? So as EM trade just continues to slow, I think these are kind of the signs that things are not improving. So the way I look at it is I say, okay, we've seen this little bit of a comeback of some of the cyclical stocks and some of the EM stocks. How I would want to be positioned for this is I would look to fade it and think, okay, well, the central banks are going to try to come back to the rescue. If the U.S. can avoid a recession, which I think they can, although growth may slow there, then I want to kind of be barbelled in some of the quality tech names, some of the defensive sectors in the U.S. economy, and then some of the sectors that are exposed to lower yields, like there's some areas of the housing market I would like, not the home builders, but lumber firms, for example, because I'm assuming, look, rates are going to come back down, and long duration is going to do well. The growth stocks or pockets of the growth
to my
stocks
ears. This
are
is
going to do
beautiful.
okay. Well, it's if the banks go back to stimulative policy, which increasingly it looks like they're going to be forced to do, what's going to benefit from that?
Right. Okay, so Aidan, it was fantastic. I sat here mesmerized. Like seriously, like these chart pack that you put together was fantastic. I just want to let everybody know. Make sure you sign up for the Market Huddle weekly chart kind of email, because Aidan was kind enough to include his full kind of 50-page chart pack, and it will also include these last 10, 20 slides that he's gone through here. Before we let you go, Aidan, why don't you tell us a little bit about where people can find you, what your firm does, and where people can reach out to kind of learn more about you?
Sure, yes. So I'm head of global macro strategy and research at Pavilion Global Markets. We are an agency-only broker out of Montreal, Canada. We run a 24-hour trading desk here. Global equities on an agency-only best execution basis. We don't trade against you. We don't take any prop risk. We don't sell your flow. And so, I run the global macro shop here, which effectively tries to put out actionable trade ideas for institutional clients. And we have a high value-added trading service that comes along with that. On the front of the chart deck is my email, so feel free to email me at agarrib@paviliongm.com. You can see it there. You can also follow me on Twitter. My handle is @Aidan Garrib, all one word. I tend to share a lot, and I don't really post much original stuff on there yet, as I'm trying to work through some compliance related issues with respect to what's free speech and what the regulators can ding you for. But you can definitely hit me up by email, and I respond pretty well to DMs on Twitter.
Well, that's terrific. So for everybody else,
perfect.
make sure you stick around, because Aidan's going to stick around as well, and we're going to have a terrific after-hours section where we talk about the U.S. dollar and go through many more of his 50-page chart deck and talk about what he foresees in the macro world and what trades you can put on. So thanks again, Aidan. It was great having you on.
My pleasure.